Microsoft is one, if not the most impressive business in the world. From its inspirational startup story with Bill Gates, to its stagnation under Steve Ballmer, and then its reinvigoration under current CEO Satya Nadella. This is a quote-unquote technology business that has well and truly stood the test of time. With a current market cap of $1.8 trillion, Microsoft is currently the second most valuable company in the world, just behind Apple. However, like I mentioned, the stock, more so than the company, has gone through some very hard times, with the stock not recovering from its dot-com bubble high until 16 years later, even though the company itself had managed to grow revenues every single year for almost 20 years. In the past 5 years, however, shareholders of Microsoft would have received a 4x from holding during the period due to their innovations in software application and remarkable acquisitions and a change in business model, which led to Microsoft tripling annual profits over a 5-year period. Now, as you probably all will know, Microsoft is a business with various different products, well-known household products, but in terms of how they report revenue, they split the business into 3 operating segments. Firstly, productivity and business processes. Second one is intelligent cloud. And then the third one's more personal computing. So to tell you what makes up those 3 segments, what products underlie those 3 segments? Well, productivity and processes, you've got all of the Microsoft Office programs such as Office 365, which licenses your Office, Excel, Teams, PowerPoint, Skype for Business, etc. Other Office consumer programs such as Skype, Outlook.com, and OneDrive. You've got LinkedIn as part of this as well, which is the professional social networking site, which, by the way, was one of the most impressive acquisitions today and almost has no competition, which is brilliant. Lastly, part of this segment is Dynamic Business Solutions, which is more niche products to data and cloud-based solutions for CRM. And all of these products are subscription and services-based revenue, which has boosted sales growth dramatically from that SaaS-type approach to generating revenue. And in the Intelligent Cloud segment, where it's pretty much dominated by Azure, as you would expect, the cloud services product, but also include things like SQL and some of the Visual Studio products as well. This is the fastest growing segment of the business currently. And then the third segment, the more personal computing, includes things like the Windows products, which is the online operating system, the most dominant system in the world today. You've also got physical products like the Surface Pros and PCs and accessories that they sell. Also part of this is gaming and realistically just Xbox and all of the products that it provides through that. And then search, which is Bing. I know Bing gets forgotten about quite a lot of the time because its biggest competitor is Google, which pretty much dominates that market. But Bing is a viable business and produces a lot of revenue for Microsoft and is very profitable. So as you can see, Microsoft today is a very well-diversified portfolio of businesses and product that all contribute meaningful revenue and meaningful profit, as well as a runway for growth, with all of them being in higher growth markets. And the main themes here are cloud, computing, digital advertising and media, and gaming, which are all high growth industries. If we look at the compound annual growth rate or expected compound annual growth rate of those TAMs, they've all got double-digit growth rates going into the next 3 to 5 years, which is a massive positive for me. And it's evident here from the 2020 highlights that yes, cloud is growing rapidly, but other than that, no segment is holding up any of the others. There is double-digit top-line growth in every meaningful segment of the business, which is just fantastic to see for a company as big as Microsoft. And yes, Microsoft is a business that is already very large in of itself, 143 billion of revenue as of June 30, 2020. And yes, it's got a market cap of 1.8 trillion, which seems huge on the face of it, although they do have some of the best operating income numbers out there. But this is a company that can't stop growing even with its size. Every time it's got to a point where people think it might peak, it manages to grow top-line revenue and sales even more. And not only does it do that, but it benefits from economies of scale as it gets larger. It keeps getting more and more profitable as it grows because it's switched to that services and subscription type revenue. And I think there's still a good runway for growth left for Microsoft. Not only are they buying back $20 billion worth of stock annually, probably even more if they can't find anything to do with $132 billion sitting on their balance sheet, but they are part of some really high growth industries. The obvious one to talk about is cloud services, which is dominated primarily by Azure as the product, which grew 50% as of the most recent quarter. And as of 2015, this thing has just been growing. We can see 5 billion in one quarter in Q2 2015, all the way up to 44 billion as of Q4 2019. So not even in 5 years has this thing managed to 10x in what it's doing quarterly in revenue. And Azure isn't done either. As you can see, this might be a little bit blurry, but this is the cloud provider market share. And obviously, Amazon, AWS dominate the market currently. We can see Google, Alibaba, IBM, some of the more notable names in there at all. But we can see Microsoft have just been stealing market share since 2017. They've got the most linear lineup out of all of the companies, and they're the fastest growing cloud segment of any of these businesses. And it seems like they are eating away some of that new market share that's coming into the market. Because it is a growing market, they're taking some of that away from the likes of AWS and Amazon. And it's one of those rare cases with Microsoft that not only do all of the segments of the business make up a similar piece of the pie in terms of revenue, they do also have very similar profit margins, with every segment of the business being profitable, and actually profits growing quicker than the top line revenue is, so showing us that scalability. And when you look at it, there's a lot of reasons why you should buy, or at least consider looking at Microsoft. Firstly, they've got a history of excellent performance and reinventing themselves when growth starts to stagnate. Secondly, they're a dominant force in almost every single market or product that they are in. Third, they've got huge growth potential. Even for someone as large as they are, they have their toes in so many different industries, and they're all high growth industries, as we've covered. So there's real growth potential there, even with the size. So what we want to know as investors is Microsoft potentially a good buy at the moment? And ideally, we want to know, is it the best big tech stock, or FAANGM name that we have out there? We're going to put Microsoft into a valuation. We're going to forecast the next 5 years for Microsoft, and then discount all of that back to today and see what is a fair price to buy Microsoft today at. Okay, let me talk you through the forecast. First of all, you can see the historical results here on the left, as always, formatted as we always have it, really. Microsoft results run to the end of June. So this is technically conservative in the sense that on a trailing 12-month basis, they're already at 155 million of revenue, or 155 billion of revenue. Sorry, I'll double check that after. But so, you know, they're near enough to their 2021 target that we're setting them here. So just keep that in mind. You know, these are already 6 months behind. But we can see Microsoft, as we've already covered, posted fantastic numbers. I've done some of the calculations here in the blue, which are the formulas we're going to carry over into the forecast. Just things like their EBITDA margins, their profit margins, their free cash flow as a percentage of net income, which is going to be what we use to calculate free cash flow going into the future. So we can then discount all of that back and then get a fair value from those streams of cash flows for a fair price to buy the stock today. Just summarizing my assumptions here, you can see I've gone with revenue growth of 15% over the next 5 years, and I'll tell you why I did that. I did a projection by business segment rather than product, but it's focusing mainly on the products that underline those segments. So for productivity and business, I've got the Office programs that underlie that are the main driver of revenue in that segment. They're currently growing at 15% on a 3-year average. I've taken that growth rate down slightly, and I've said that in the next 5 years, they can grow at 12%, which is still a very good growth rate for a $46 billion business. That will get it to $80 billion in 2025, which would be a huge amount. The intelligent cloud segment, which is, if we're being honest, mainly driven by Azure. And that, I mean, Azure itself is growing at 50% as of the most recent quarter and year. The segment as a whole is at 25% as an average. And I think it has the potential to even maybe be more than that. But if we're talking about a 5-year period, we'll go with a 25% average growth rate. And that gets us to 147 billion of revenue in 2025 just for that segment. And then the more personal computing, which is essentially Windows operating system, Xbox, and search with Bing, I've gone with that at 7.5%. I mean, we've got Xbox is growing at quite a quick rate. Bing search is growing at a quick rate as well. Talking 15% plus with both of them. But the Windows operating segment is the one that is the dominator in revenue, or the largest part. And it's lagging slightly in revenue with single-digit growth as of the most recent quarter. So I wouldn't be surprised if we see single-digit growth in that segment. And that totals to about 298 billion of revenue in 2025. So I'm slightly off that at the moment with the 15% flat growth rate, but it's there or thereabouts. So it's not going to make too much of a difference. EBITDA margins, I've gone with their average, which is 41%. over the past 5 years. They've actually got, as you can see, they're trending more and more profitable as time goes on. So I actually think, those profit margins could go up, especially when things like Azure get more profitable than they are now. So we've really seen they can benefit from scale. Free cash flow as a percentage of net income, I've gone with 107%, which is the average there. And then cash growth, I've gone with just 5%, just because they've already got so much cash on the balance sheet. I wouldn't expect them to hoard any more cash. I'd like to actually see them invest it for growth, which they do on occasions. I think they're rumored to buy Discord at the moment for 10 billion. So Microsoft do like making acquisitions, and they're very, very good at it. So I'd like to see some of that cash spent. Debt growth, none. Debt's been constant for the past sort of 5 years. 70 billion, as you can see here. So I didn't show you the cash previously either. And then I've got a decrease in shares outstanding of 2.5% across the period as well. So they have been buying back some shares. They do have a share buyback program. They can probably buy back around 2.5% at a minimum of the market cap going into the future, with the amount of cash that they have and the amount of cash that they generate. Look at those cash earnings, 65 billion of cash earnings just from 2020. Now, for my terminal values, I've gone with a pretty basic 2.5% perpetual growth method for one, and then a 20 times EBITDA multiple, which gets us to an average of 2.5 trillion for a market cap in 2025, which is a big, big company, but not actually that far off where they are now. And now I want to look at the DCF. Let's have a look at what the fair value is for Microsoft today based off of that. So we've got a market cap in 2025 of 2.5 trillion or 2.6, there or thereabouts. You'd say not far off where it is now, so it must be a terrible return. Well, not quite, because we've got them shares being bought back, 2.5%, which is fairly conservative considering how much cash they have and generate. And at a 15% discount rate, which is my required rate of return, we have a share price today, if we want to buy the stock and get that return, of $212 per share. Unfortunately, and that's 1.4 trillion for the company. Unfortunately, we're at $237 per share, so we're about 10% overvalued as of the current stock price. Now, what I will show you is this slightly different valuation. This is called the bullish valuation, but the only difference is we've got 20% growth for the next year, which is around about their guidance, and then 15% growth after that. That gets us to 300 billion in revenue. All the margins are the same, but what I've done is I've applied a free cash flow yield to the price as our terminal valuable multiple. I've got rid of the perpetual growth rate and gone with a free cash flow yield of around 4%, which is good in any market, especially with a safe company like Microsoft that will always have some hint of growth in it, especially in the next sort of 5 years and the high growth industries that it's in. So let's say a 4% free cash flow yield is what it's selling for. Then we have a company that's worth 3.3 trillion as an enterprise value in 2025. And if we discount that back today at 15%, then we get a share price that tells us it's undervalued by 13%. So, what am I trying to do here? I'm not trying to confuse you. What I'm trying to show you is that what the fair value for Microsoft is, or any stock today, is relying upon your forecast, and how convinced you are by your forecast, and especially the terminal value is going to play the biggest role in it. Quite frankly, with Microsoft, I'd like to be as conservative as I can because it's already so big. It's a very, very convincing company. It will continue to grow, but it's at that size where growth will eventually slow. And I don't know in 2025 if we'll have indicators of that, and the market's not going to be selling it at a premium anymore because it has hints that growth may slow. That's why I've got the perpetual growth method in there, and I've only got a 20 times EBITDA multiple. Now, lastly, one thing to note is that all you need for this to be a fairly valued stock is your discount rate to be a little bit lower, even with these more base case assumptions. So it indicates here that you could have a 12 to 13% rate of return if you were to buy Microsoft today and these projections were to play out. So in reality, it's only that my required rate of return is as high as 15 that this isn't a fairly valued stock today. In my opinion, Microsoft is one of the more fairly valued FAANGM stocks out there currently, or big tech stocks. I think Facebook's probably slightly better valued for the growth you're going to get out of it in the next, say, 10 years, but Microsoft is definitely up there. But let me know what you think of Microsoft in the comments below. I'd be keen to get your opinion. As always, this spreadsheet and the two valuation models, as well as an IRR calculation that I'll throw in to give you your indicated return, will be available to anyone on Patreon or on the Discord. So be sure to head over and check that out, see if you're interested in supporting the channel. I'd also appreciate if you can hit the like button if you enjoyed the video, subscribe to the channel if you haven't already, and I will see you all in the next one. Good luck with your investments.